Welcome back to Investing Talk Podcast.
Today we're looking at Broadcom.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. To really understand Broadcom, you have to look past just semiconductors.
Right. It's a much bigger story now.
Exactly. What we're seeing is this transformation into an AI infrastructure powerhouse. It's driven by this powerful dual-engine growth story.
Cutting-edge hardware on one side.
And incredibly sticky, high-margin enterprise software on the other.
And that dual engine, I mean, it's undeniably translating into some just monumental numbers. But we have to dissect them a bit, right?
We do.
We just got the Q1 fiscal 25 snapshot. Total revenue at $10.92 billion. That's a massive 36% jump year over year. But the first question is, how much of that is, genuine organic growth versus just the sheer scale of the VMware acquisition coming online?
That's a critical distinction. And while VMware definitely gives a huge inorganic boost on the software side, the real acceleration is happening in the core semiconductor business.
Okay.
But before we even get to the top line, just look at the efficiency. Operating income was $5.56 billion, up 53%.
Wow.
And that delivered a record operating margin of 50.9%.
50.9. So half of every dollar is becoming profit. That number. It doesn't just sound good. It fundamentally changes how you view the company.
It does.
Does that margin stability suggest they have pricing power that's, far beyond a typical chip maker?
Absolutely. Traditional semi companies are way more cyclical, more margin pressured. Broadcom's hardware side is protected because most of that growth isn't from commodity chips.
It's from the high-value custom work.
Exactly. The ATICs, or application-specific integrated circuits.
Okay, so for listeners who might not be deep in the jargon, what does custom ASIC actually mean in practical terms?
Well, think of it this way. Instead of selling a standard processor, they're selling the hyperscalers, Microsoft Azure, Meta, Google, the exact custom-built blueprints for the silicon they need.
For their specific AI models.
For their unique AI models and data centers. It's a dedicated, high-margin, bespoke product.
And that's where that 44% year-over-year growth in semiconductor revenue came from, hitting $7.99 billion.
Precisely. It was the custom ASICs fueling AI. They reported shipping about 20 million AI-related custom chips in that quarter alone.
Which is, what was the growth on that?
A staggering 120% increase year over year.
Wow.
And that massive surge is why management is so confident. I mean, they're aiming for more than $120 billion in AI revenue by 2030.
That's a six-fold increase from where they are now. It's a huge projection.
It is. But it's only believable because of that customization factor. They're enabling the next wave of AI that doesn't just use off-the-shelf parts.
Right. But like you said, the hardware is only half the equation.
The dual engine.
That high margin we talked about is just as dependent on the other half of the business, the infrastructure software.
Yeah, and this is where years of huge M&A deals ending with VMware really start to pay off.
So what's the state of that software engine today?
It provides critical stability and massive, massive cash flow. Infrastructure software revenue was $2.93 billion, up 19%.
And that's from renewals in the legacy segments.
Strong renewals, yeah, from places like CA Technologies and Symantec. And critically, their net dollar retention is still high at 114%.
So existing customers are sticking around and spending 14% more year after year.
It just shows you how sticky those products are.
I see the value in that non-cyclical revenue. It's a fantastic hedge. But what about strategy? They just spent $6.1 billion on Velis Technologies.
To augment their generative AI software stack.
So when you combine that with VMware, the strategy seems pretty clear. They're building a full-stack AI infrastructure position.
It's a very intentional, very aggressive strategy if you control the high-performance hardware.
And you also control the software that manages and optimizes those exact systems.
You're building a powerful symbiotic monopoly.
Which sounds great. But doesn't controlling the whole stack also create some intense integration headaches?
That's the main execution risk, sure. But so far, the integration seems to be about specialization and consolidation. They're focusing on monetizing the biggest customers first.
The ones where the custom chips already live.
Exactly.
Yeah.
And the benefit of controlling that full stack is just so immense. It creates this competitive moat, which brings us to our second big point. Their indispensability.
So their strength isn't just about volume. It's about making themselves irreplaceable Why is it so hard for a competitor to step in right now?
It's the vertical integration. They don't just sell you one chip, they sell you a full proprietary system.
Okay, so that includes the custom ASIC?
The Tomahawk switches, which are basically the traffic cops for data center networks, the controllers, RF components, and all the networking software that ties it together.
So a single data center component relies on 5 other integrated parts, all from the same vendor.
Yes, and the largest hyperscalers, Meta, Microsoft, Amazon, they design their entire multi-billion-dollar AI clusters around these integrated systems.
We found an analyst quote that really captured this. Broadcom's chips are the plumbing of AI data centers. You don't change plumbing mid-build.
That's the perfect way to put it. The switching costs are just immense. If you're a big cloud provider and you decide to swap them out for a competitor, the complexity means you're looking at an estimated 18 to 24 months of total re-architecture.
18 to 24 months. And in the AI race, where every single month matters, a 2-year delay is a non-starter.
The time advantage is the moat, and it's protected by their IP. They hold foundational patents on next-gen standards, things like PCIe 6.0 and 800G Ethernet.
Which govern how fast data can move inside a data center.
Right. So if you want to build the future of high-speed networking, you're almost certainly paying them one way or another.
Which brings us to the financial side of this. If you're that indispensable, you generate extraordinary amounts of cash.
A true free cash flow powerhouse. Let's talk numbers here, because they're staggering. In Q1, free cash flow, or FCF, hit $5.92 billion. That's up 51%.
But the metric that really stands out is the FCF margin, 54.2%.
It is.
For context, what does a margin like that really mean compared to their peers?
It means for every dollar of revenue, 54 cents turns into cash they can use for R&D, acquisitions, or shareholder returns. It's among the highest globally for any large-cap tech company.
And they're maintaining a strong balance sheet. Even after all the M&A, they have, what, $11.8 billion in cash? But we have to talk about the debt. It's substantial, $78.7 billion.
It is, but they are paying it down. It was $81.5 billion last quarter. And you have to look at their capacity to service that debt.
Right.
Their net debt to EBITDA ratio is 1.8 times. For a company this acquisitive in this sector, 1.8 is actually considered very healthy.
And the market is comfortable with that because the cash flow is so high and stable.
Exactly. Thanks to that software segment. They're proving they can pay down principal while growing the business. And their capital allocation strategy shows that confidence.
So how are they channeling all that cash back to shareholders?
It's dominated by share buybacks. They repurchased $5.1 billion worth in Q1 alone.
Wow, in a single quarter.
Yep. Over the last year, 36% of their free cash flow went straight to buybacks. It's a very efficient way to boost EPS.
And for income investors, they also have a growing dividend, currently a 1.3% yield. It's a great mix, really.
It is. High growth from AI plus stability in cash returns. So let's shift to the near-term picture. Momentum and upcoming catalysts.
The technicals here seem to be confirming the fundamental story, right? We've seen some powerful signals.
We have.
We saw the stock confirm a breakout. It moved above that multi-month ascending pattern, blasting past the 1520 resistance level on high volume back in April.
And if you track indicators, you'll have seen the golden cross in March.
For those not glued to the charts, what exactly is a golden cross and why should that matter?
It's when the 50-day moving average crosses above the 200-day moving average. It's generally seen as a very bullish, long-term signal.
And this was the first one since 2021.
Right. It tells you the market sees a major, durable shift in its trajectory.
And that's backed by institutional money flowing in. We've seen a net inflow of $3.2 billion since January.
And even more compelling, look at the insider confidence. The CFO, who knows the books better than anyone, made his largest share purchase since 2020.
Buying 5,000 shares worth $7.2 million.
When executives put their own money to work like that, it's a powerful vote of confidence.
Okay, let's look ahead. The catalyst calendar for the next few months looks pretty packed.
It does. First up, April 29th, the Q1 earnings release. Consensus is around $12.55 billion, but the whisper numbers suggest a possible beat.
And the focus there will be on the AI revenue growth rate.
Entirely. Then on May 15th, you have their Investor Day. This is a critical event. They're expected to unveil their AI ASIC roadmap, potentially through 2028.
That's where we'll see if that $120 billion target for 2030 is actually achievable.
Exactly. And then in June, at the OFC conference, they're expected to demo their 1.6 terabit Ethernet switching chip, potentially an industry first.
And why is a 1.6 terabit chip so important for the AI story?
Well, to run these massive language models, you need to move colossal amounts of data between thousands of GPUs incredibly fast. This is the next step up. It just reaffirms their IP moat.
And then there are the speculative catalysts, rumors about a deal with a Tier 1 auto manufacturer.
And chatter about their involvement in a major AI partner's mega deal. Lots of things to watch.
Okay, so to be balanced, we have to pivot to the risks. The bear case. There are two primary vulnerabilities here, aren't there?
There are.
The first one is just valuation. The stock trades at roughly 29.2 times forward earnings. That's extremely high compared to its 5-year median of 17.
That's the core risk. The market has priced in a tremendous amount of future AI execution. If that growth slows, or if macro headwinds return,
You risk significant multiple compression. The stock could fall even if earnings grow, just because the market won't pay that premium anymore.
right. And the second major vulnerability is customer concentration.
The company is deeply reliant on a very small group of giants, isn't it?
It is. The top 5 customers, Microsoft, Amazon, NVIDIA, Meta, and Google, count for 42% of total revenue.
That's a hefty concentration. The company's performance is basically leveraged to the CapEx budgets of just 5 companies.
And that's the single point of failure risk. If any of those customers slow their AI spending, it could materially impact demand overnight.
But I guess that's where the software segment comes in as
Yeah.
mitigation, right? How much of a buffer does it really provide?
A substantial one. That enterprise software generates around a 75% EBITDA margin. It's stable, non-cyclical, and it's tied up in long-term contracts. It stabilizes the cash flow against the volatility in the AI hardware segment.
So this really paints a picture of a company that has strategically made itself the essential plumbing of the AI revolution.
It's a compelling structural growth story, provided they keep executing on the VMware integration and manage that debt while hitting those very ambitious AI targets.
If their chips truly are the foundational plumbing of the AI data center, the question isn't whether AI is growing, that much is clear, but how long it will take for the market to fully reflect the strategic weight of this hardware and software synergy in their multiple, especially if they manage to achieve that audacious $120 billion AI revenue target by 2030.
If you enjoy this analysis and want more deep dives like this, make sure you follow us wherever you get your content.